still Rosen, and I chair the real estate group at Becker. Most people know the firm Becker Poliakoff. So we're the largest Broward-based law firm in the state of Florida, 13 offices throughout Florida, New York, New Jersey, and Washington, D.C. And what I do for clients is I help my clients buy, sell, lease their properties. We represent lenders, developers, all across all asset classes, and not only just in Florida, all across the country. So Greg asked me to do this. I was really excited because I have quite a few clients who are in the multifamily space, and in that space, I have personally seen a big change over the last several years. And so what we're going to talk about today is really where is the capital coming from and how are deals getting done. I think the first panel did a really good job talking about what's going on in the market, and I think we're going to get a little bit of a different perspective from the folks that are up here today. I will tell you that from personal experience with my clients, I've seen that over the last year or two, it's starting to take them a little bit longer to get their deals underway. They'll sign the contract, but they don't have the choice of 5 lenders anymore. Maybe they only have 2 or 3, and they don't love the terms they're getting. And it's harder for them to raise equity as well. Some of them are resorting to some more expensive equity. And when you couple that with everything that the last panel was talking about, I think there's a lot less room to make a mistake in your underwriting. And we just saw all the insurance information up on there. If you don't buy your insurance right and something happens, you really could be in a world of hurt. That's a negative. I think there's a lot of positive to it too. We're going to tease that out. So what we're going to do is I'm going to actually let each of the panelists introduce themselves, give a little anecdote, tell you who they are, what they're doing, and then we will jump right in. So first, Noah, I'll let you get started.
Sure. Thank you, Phil. I appreciate it. Thanks, Franklin Street, for putting this on, and everyone for coming out today. We really appreciate it, and I think the first panel was spot on, and they did a great job, so I hope that we can add to that. My name is NMiller. I am the Vice President of Acquisitions and Finance for Pensam Capital. We're a private multifamily owner-operator investor based out of Miami, Florida. We currently have a portfolio of about 30,000 apartment units, split up between properties that we own and operate, which is about 15,000, garden-style suburban Class A, B, and C throughout the country, as well as another 15,000 or so that we either have preferred equity, mezz-on, or some sort of debt position. I would say that we are in a very interesting part of this market, and we'll get more into that. I think on one hand, some people think that there's a lot of aggressive groups out there, and I think on the other hand, people think there's a lot of conservative groups. So I think we'll dive into the differences and what I'm personally seeing as an owner-operator and also as a lender.
Thanks a lot. And thanks for Franklin Street for co-hosting this and doing all the real work for the event. So we just kind of sat back. But my name is Aaron Kurlansky, principal at FM Capital. We're a full-service real estate investment company, and really our primary focus over the last 12 months has kind of shifted to debt. We have a balance sheet. We've done about $250 million in the last 12 months of bridge lending. We do buy some distressed debt, and we still do make some select equity investments, but just because then we'll get into a little bit more, shift in the market a little bit, and the amount of appetite out there, we've really primarily fully focused on our debt business going forward.
My name is Elvis Dumervile, CEO of Prestige Estates. Our main quarters in North Miami Beach. By the way, Franklin Street, we appreciate you guys setting this up. For Prestige Estates, we're a value-add real estate business. We also do kind of behind-the-scenes construction. So we're focused more on distress, and we're trying to do value-add. And like I said, our sector is more mainly in North Miami Beach. So we like all the worst buildings in the area. We roll our sleeves up and we do what we do. And that's kind of where we at. And we also deal with acquisitions to renovation and to managing. So it's a full circle type of service we provide, and that's kind of our story.
All right, great. So thanks for the intros. You already touched on some really interesting points. And so, Noah and Aaron based on what you guys have spoken about, I know especially it's interesting to see that you guys have amassed so many units, but that you really kind of shifted into doing more lending and equity investment. And Aaron, it seems like what got you where you are now, you've sort of gone away from that. So, you know, from the time that you started and you formed FM Capital, what's different now about the way that you see that you underwrite transactions on the purchase side and then on the lending and the equity side?
Yeah, so I would say over the last couple of years, obviously, if prices have doubled since, you know, when we were buying it actively in 2010, 2011, 2012, if not more than that. When the deals actually penciled out on paper, deals made sense. Nowadays, you have a lot of new people getting into the buying space, thinking that everyone else made money in multifamily, I should get into. You know, banks on the agency side are definitely generous on the lending, and the equity's out there for the deals. So, you know, a lot of the new buyers that are paying premiums for these types of deals, I always like to say they don't know what they don't know. So until it's going to probably be a little too late. They think rent growth always goes up. You know, the market, everything's always good, and if you slap some granite on in the units, that you can raise rents $150. So that doesn't really always work. You know, you really have to be truly focused and hyper focused, you know, on the day-to-day. So from our perspective, we took a pause on it mainly because we're lazy operators. So we make our money on the buy. We don't make our money on the value add. We don't roll up our sleeves. So if we can buy it cheap, I'm a buyer, but I can't buy it cheap these days. So I'd rather be a lender in this market. It's easier to call up a guy and say, make your mortgage payment every month than actually do the work.
So that's an honest answer right there. So when you then decide, hey, you know, we're going to lend instead, how do you resist the urge to say, I wouldn't buy this, but I'll lend on it? How do you kind of justify that?
I mean, you hope that your basis is good. You know, we've always bought on basis. So if it's what's your price per door? You know, you can break it out. And if we have to take it back, you know, sometimes loans go bad, and sometimes you deal with foreclosures and litigation, bankruptcy, and we've kind of been through the full service of it all. And you know, it sounds better than it is when you lend at 75%, like, oh, we'll own it at 75% leverage. It's not so fun, the process to get the real estate. But if your basis is good, your basis is good. All the other stuff is kind of, you know, we hope they'll do their pro forma, we hope they'll hit their plan, but like worst case, we just lend on basis mainly.
I want to touch point on part of the original question, which was underwriting and how it's changed, let's say, over the last not only 1, 2, or 3 years, but over the last 10 years. I think that people talk a lot about underwriting changing, but I don't know if it has. And the reason I say that is, you know, we're in an interesting position because one, we're behind properties, but two, we're providing preferred equity. So we see a lot of other operators underwriting. And insurance, it's topical because we just had, you know, the individual talking about it. I can tell you that insurance has gone through the roof. 20%, 30%, 40% over the last couple of years. When I see an underwriting from certain sponsors out there, they're still underwriting insurance like in 2009, 2010. I mean, I still have people sending me underwritings where a South Florida deal has an insurance cost of $250. I mean, that's outrageous. There's no one ever who's going to get insurance for $250 on a South Florida deal. It's going to be closer to $400, $500, if not more. So I think that people lie to themselves on underwriting still to make deals work. And you know, it's the saying, you know, the good thing about Excel is everything works in Excel. The bad thing about Excel is everything works in Excel. So I think that when you're underwriting deals, whether you're a lender or buyer or whoever, you have to be very honest. And you have to put forth the numbers that are real. And if the deal works, great. But if the deal doesn't work, that's okay too.
Right. Okay, so Elvis, you're coming at this from a little bit of a different angle, right? You are, I think, trying to become the king of North Miami Beach, and you're in a unique spot. So tell us a little bit about how you look at your deals and underwrite them, because you told me a very interesting, made an interesting statement yesterday, and I hope you'll say it again. If you don't, I'll remind you. But tell us a little bit about the underwriting where you're running.
Please remind me.
Well, you said you want the worst building on the block, and you're creating your own market there.
Right. So, unlike Aaron, you know, I know back in the days, Aaron used to roll up his sleeve, but unfortunately, he's retired. So now that I'm retired from the NFL, you know, I have the energy still to be able to transition to building up my sleeve. And for me, when we look at a deal, you know, so we have so many buildings in the North Miami Beach sector, we pretty much understand the rents in that market. You know, we're not, you know, we're not all over the place. We like to stick to what we know. And so for us, we know we're getting, for example, in a 2-3 mile radius, one bedroom, 1150, 1200, and we're looking at a building where it's distressed and they're collecting $750, $800 rents. We know there's potential there. Now, I think what separates prestigious estates from most people is that we kind of have the construction side on the ground that is in-house. So that way, we're able to control the renovation process to the rental process. And that gives us an opportunity, and I'm able to relate to my laborers, the guys that we have working for us, and the construction side, because honestly, as Aaron alluded on, when you're buying at the right price, you're making your profit. But then, if you can control the construction costs of material purchase, those type of things, it really gives you a better opportunity to really, you know, like Noah mentioned, to fulfill those underwriting, you know. And so for me, it's all about seeing the vision. For me, I can see the building. Like I'm an intuition type of guy. If I don't see the building, I can't envision it, I don't touch it. Most of the building that we acquire is very unique. It has a strong unit mix and location, and the size of the capacity of the land location is paramount for us. And for that reason, if I have buildings across the street from each other, it's no longer, let's say, for example, two buildings at 30 units each. I look at more of a 60-unit building. And for me, I don't have to bring in more guys for expenses to go manage the other building. So the same guys that I have, that the maintenance guy can manage 3 or 4 buildings on that one street, and that's how we're able to leverage the expense. So my approach of acquisition is a little more unorthodox and differently, but it's worked for us. We've been in existence since 2016, and we're able to amass almost 700 units.
And by the way, I know anytime I've ever met with Elvis, it's on site. And I know plenty of unit owners that if you live in New York, you buy a deal in the Carolinas, you know, myself included, there's some deals I haven't visited of ours because we own it cheap in a long time. And if you're boots on the ground and you're there grinding it out every day, deals can work, you know. But if you're just someone that's buying on Excel, it's very hard to make deals work in this market. You know, 5 years ago, definitely doable. Anyone put some money together, you can make some money. But nowadays, you really got to grind it out day after day on site.
I think there's one thing I want to touch on, because Aaron and Elvis are 100% right, which is at this point of the cycle, there's a difference between people who are just buying and people who are actually operating their assets. And what Elvis is doing is operating his assets, and that's going to make a big difference. I mean, one thing we've done at Pensam is we're not buying as much as we used to. So what we've done is we've looked inward and said, okay, how can we make sure that our on-site management is the best possible? And are they actually answering the calls when people have issues, whether it's ACs or plumbing? You know, are maintenance guys actually getting there? Because if not, and there's an issue on site, they're going to move to the next property. So what Elvis is talking about, which is actually being on site and making sure the residents are happy, that's what goes a long way in this cycle to make sure that your properties are full and your tenants are happy. If your tenants are happy, they're going to stay. You'd much rather have a tenant staying than turning that unit every single time.
And to piggyback on Noah as well, speaking of residents and customer service, you know, we found that, you know, people actually pay the rent that you're asking for, but the product is there. And the next and most important thing is the customer service. And that's one thing we really harp on at Prestige is, you know, they'll pay the rent, but they'll be calling the office and they require, and they deserve it, you know. So we really try to harp on the customer service, because without that, I mean, you know, it's, even though sometimes residents sign leases, they just feel like, well, they didn't come fix my AC, I'm not going to pay rent this month. Even though they know that's not the way it works, you sign a lease, you have to pay your rent, but it's the fact that we want to keep the renewal at a very premium. We want to keep that high, so the less turnover we have, making sure the residents are happy, is better strong cash flow.
So it just occurred to me, something that you both mentioned about property manager, and I think about the clients of mine that are vertically integrated, that have their own property manager and have their own construction and are more hands-on. I was going to list the clients in my mind who are vertically integrated and the ones who aren't. And right now, the ones who are vertically integrated are having an easier time finding deals, and they are closing their deals at a higher clip than the ones that aren't. So I didn't even realize that until you guys brought that up. So I want to talk about something that Greg mentioned, and candidly pointed out that he's got people who would like to see sell, but they decide that maybe it just pays where we are right now to refinance. So have you seen that? Do you have some of your assets, or maybe you think of selling, but instead you're saying, we're going to hold on to this and refi and kind of ride this thing out right now?
Did Berkadia put you up to that? Is Kyle here? No. There he is. I'll give a little anecdote. I feel like I'll fall on the sword in public. So yeah, we had an asset in Hollywood that we tested the market. We dual tracked selling the property and refinancing it at the same time. And although he was able to get a great price for us, the rates dropped over the process, and our investors said, "Great, you're going to give us back. We're going to make a great return on our money, but now what?" I said, "Well, maybe you should call, someone else maybe is buying, but it's not really for us." So, because one is you're avoiding paying taxes, obviously, so there's no capital gains issue, and the leverage is so aggressive with such cheap money now, low 4% range on fixed term money. It's very compelling to just say, I'll refi and I'll keep it, and now maybe we won't make a ton of cash flow anymore, but we have a great option play. It's a covered land play for the future if we believe in the area. So we're definitely seeing that as all of our assets that we own together with Monument that are down here in South Florida, we're pretty much refinancing, putting long-term debt and keeping it, because it doesn't really, even though the prices are great, the returns are great, it doesn't really make sense to sell because there's nowhere to go with the money.
Sure. So, Noah, let me ask you this. So we're talking about these types of loans, right? So if you have a property that you've owned for a long time, are underwriters looking at them differently? And if you're lending to someone who's maybe just refinancing versus someone who's acquiring, do you not trust that newer buyer as opposed to someone who's owned it for a long time?
Perfect. It's funny, I didn't even think about it, because we hadn't talked about that before, but I have actually a perfect story for that. We don't sell a lot of our deals, we're mainly long-term holders, but we put a deal on the market in Texas. This was maybe 9 months ago, a year ago. It was an asset that we owned for 6 years, and it was a solid, let's say, C+, B- asset. Put on the market, goes under contract. A couple weeks later, when it's in due diligence, I get a call from a broker who I know, by the way. And he says, "I have an amazing opportunity for you guys to do preferred equity on this deal. Tell me about it." Because this deal's a solid B deal, and this group's going to take it to an A-. It is in a prime location. The demographics are stellar. The current owner doesn't know what they're doing. Complete idiots, so on and so forth. Turns out it's the deal I'm selling. We knew that asset better than anyone. I've used that asset 100 times. I knew the manager, the assistant manager, the maintenance guys, and everyone. I knew what the asset was, and I knew the true asset. The incoming owner had a dream. I hope for their sake that they can achieve their dream, and I hope that they get the $200 rent premiums that they were underwriting. But yes, to answer your question, we look at it a little bit differently when someone's buying an asset that seems like all the value's been taken out already. And again, as an underwriter, whether it's a bridge loan or preferred equity, we're very conservative with that. And I'll see the underwriting all day long from the sponsor that shows they're going to get $200 premiums, but we run our own analysis, and if we only believe they can achieve $50, that's what we're going to underwrite. I'd rather lose every single deal than start doing debt on deals that I think that the deal's going to come back to us on foreclosure. That's not what we want.
Right. Did you sell the asset?
We sold the asset, yeah.
Right.
And I don't have enough on how they're doing yet. I don't know.
Did you do the prep?
We did not do the prep, but the broker sold me good. I was like, shit, we should keep this deal.
Yeah, I'll tell you, I was in New York this week with sitting with the CEO of a very large REIT that's very active in the multi-space bridge lending, and he told me straight up that he's very concerned on the bridge side. They're kind of scaling back and pulling back, and he said, most of the guys that are buying now, they either don't have a track record or they were able to make a lot of money in this past cycle because they bought cheap, but now they're really digging into the sponsor and their ability to actually execute a business plan. And it's purely a bet on the jockey, in this market now going forward. You're just betting on the sponsor. If they're a true operator, then it's worth, maybe, creeping up the extra 5% leverage. If it's not, it's probably better to pull back and either let the deal go to someone else, the new entrant to the market, or someone that doesn't, that's a little too aggressive.
Yeah, I mean, to that point though, I think, Aaron, you and I, our company is very similar. We're pretty conservative on the debt side. That doesn't mean that most groups are conservative. I mean, I would argue the opposite. I think most groups out there are very aggressive. Maybe not the groups who've been around for 5, 10, 20 years, but the groups who've been around for 1 or 2 years and are trying to make their mark in the industry. There are deals that come to us and we think we're getting aggressive at, let's say, just throwing out numbers, 80% leverage at, 300 over LIBOR. All of a sudden we realized that we lost out because another group went 85% at 250 over LIBOR. And we're sitting there scratching our heads saying, this deal's not going to work. This deal's going to be underwater. And, so on one hand, I think that, I'd rather be in the conservative position, but it's not to say that there are not groups out there that are getting extremely aggressive and staying aggressive regardless on asset, location, and sponsor.
So I come from a different approach where, you got Aaron and Noah, you guys are more on the lending side of it. As a sponsor, I'm looking to vet the right lender because I know what I know and I'm very confident of what we can get accomplished. From my perspective, it's like, well, I gotta make sure I find the right lender who don't retrade. I'm more conscious on the guy who says we're gonna be able to deliver once we have the closing table. Now, we had a little story, a little history, me and Aaron, a year ago.
Beat up left to right here.
That was a couple years ago, was it last year? A couple years ago. It was a deal in North Miami Beach. It was funny because Aaron, I think, texted me, hey, I think I got a deal that's off market. And I said, sure, shoot me, what's the details? And all along I was dealing with a broker who was actually on the listing agent. And so when he texted me the deal, I said, oh, well, I'm already working on that deal. So we fast forward that part, and then we got into using up capital for the lending. So we had a situation we're working with one of Aaron's, one of the guys is Daniel. I think Daniel was here. Where's Daniel? There you go, Daniel. And it really, started well and it was kind of honeymoon. So, oh, we like what you're doing. And I'm like, great, man. I respect you guys. You got to do a lot of deals. This is what we want to get accomplished. They knew the deal, so it made sense. So they brought some guys so that we didn't get the deal done. And all of a sudden, it became a shit show. All of a sudden we got betrayed and just all my respect for Aaron just started getting doubted. Seriously, he came highly recommended. And, so I was like, someone told me, a good friend, hey man, this is the guy to get it done. This is what you can do. Because the sellers were asking for some real unrealistic time to close, 30 days, no due diligence. I mean, it was just insane. But I knew the potential. So it went bad fast. But I will say, it's not about what happens in life, it's how you respond. And I would say Aaron came and they rectified the situation, they fixed it, and we had a happy closing. So it was good business.
And no one said this business is fun. I mean, unless you're like a narcissist or sadomasochist, but if it went bad, it would have been weird sitting with him.
He is the NFL sack leader.
I think Dan didn't sleep for a couple nights. I'm like, yeah.
All right, so you guys touched upon something interesting before about operators and sponsors, and you're betting on the jockey, not so much the horse anymore. So right now, what are you seeing when people are coming to you to refi their properties, right? Or you're looking at an operator's track record? Are you seeing things maybe in the financials that you weren't seeing a few years ago? Maybe sometimes they're not meeting their targets. Sometimes the ratios are out of whack, whether expenses way out of line with what they thought. Sort of what you said before, but are you seeing this now more than you did, say, a couple of years ago?
Yeah, I mean, what we're seeing a lot of now is bridge to bridge. So there's a lot of guys that bought these deals a couple of years ago, were expecting to do these big value adds, and maybe they didn't hit the rents that they needed. And that's across all asset classes, really. They had these big, lofty proposals, and they're just not getting there. And, a a lot of lenders now don't want to be that second guy to give a bridge to another bridge, because it's like, it's like a bridge to nowhere at this point. So, you're definitely seeing a lot of that now. I mean, we got a call recently with a guy that bought a deal a year or so ago, and, it's over-levered. In South Florida, a good location, and it's a bank loan. It's not even like it was, some high-octane bridge loan. It was a bank loan that's totally over-levered at this point. And, we have to make the call to the guy and say, listen, in order to do this deal, you're gonna have to come up with a few bucks back to closing. It's like, what do you mean? We don't, no one reinvests equity the second time around. You only collect it once and that's it. But no, it's a real reality. If you're buying these deals with very high leverage, leverage is great for returns and great if everything's good, but very bad if you don't execute your plan.
So, we talked yesterday about competition, right, and placing debt. So I think the overall tenor of what we've been hearing so far is that it's kind of like things are good, but they're showing some signs of stress. And they're showing some signs that, hey, this isn't sustainable. So, like we talked yesterday about just the rent growth, and we talked about this earlier, that the rent growth is probably not sustainable at this rate. However, on the other hand, and I'm going to put my broker hat on, Greg trained me to do this very well, I can tell you why things are great. So, in the United States, we need to be adding somewhere in the area of about 325,000 new units every year, and we're not doing that, which is why there's a housing shortage. So we're only adding like 250 to 300,000 units. So while I know that we're seeing all this stress and we're seeing these problems, our economy is still really strong. And we have net population growth in Florida. What I am seeing though is we're not seeing so much going on down here at Miami. Like, I don't really have any clients who are buying much of anything in Miami. They're going Broward, Palm Beach, and they're going all throughout Central Florida, and they love Orlando, and I'm starting to see things in Jacksonville, which is like the last place that is still recovering, and I don't know if it ever will, but from what I'm seeing out there, it's sort of like there are still some good factors out there. So what are some positives that you're seeing out there, even on the lending side, and when you see a deal, you say, wait a second, this does make sense. So let's talk about that a little bit.
I'll start with my 2 cents. I think that on one hand, everyone thinks the market's frothy and overvalued, and it is. But I think on the other hand, there are obviously still opportunities out there. If you're not hustling to find those opportunities, you're not going to find them, because you're just going to see what everyone's seeing. Rent growth is for the most part continuing, as you said. I mean, it's not at 8% like it was in certain markets a couple of years ago. It's going back to a norm of, let's say, 2 to 3%. But I think that's okay. You take a market like Austin. I don't know how many of you are invested in Austin, but we've been invested in Austin for the last 10 years. Austin literally was gaining rent growth of 9% in 2016. 9%. That's insane. That's organic rent growth, not on renovations. And a lot of people bought in Austin thinking that's going to continue. Austin last year was negative 1%. And that's the truth of what can happen in the market, especially like Austin, that gets built up very quickly. Now, having said that, I think Austin's still a great place to buy because there's so much tech going in there and so much growth. But you just have to understand that, it's not going to be a 10% market forever. And if you underwrite a 10% market, then you're going to get screwed. But if you underwrite a conservative, growth, then you'll be okay. South Florida is another market that it's very tough. We own a couple deals in South Florida. One is right down the street called Access at One Pine. It's another market that's all 6-7% growth, and now we're seeing 2 or 3%. And I'd rather see 2 or 3%, to be honest with you. Because if we're at 8% growth, then it's getting too crazy. People are going to move frequently, you're going to have high turnover, and it's just going to cause you issues. So, I think there's still opportunities out there. You just have to work a little harder to find them. One other example of an opportunity, we bought a deal in Chicago earlier this year. Everyone talks about the value add, and the problem is what we see in value add is more of going on top of someone else's value add, right? A guy came in there 3 years ago, bought the deal. He did, black appliances with faux granite, push rents 150, and now the broker's selling you on, you can do stainless and granite and push another 150. We're not going to buy those assets. Some people it'll work for us it doesn't. We found a deal in Chicago that the owner bought it 20 years ago. he hasn't touched in 20 years. This thing was built in 1970, and literally it had, you know, laminate countertops, the green fridges. I mean, this thing was a joke, and fortunately for us, it was a deal that the broker was not very good. It wasn't a Franklin Street type broker. It was a one-off broker. He didn't know what he was doing, and we happened to be, you know, harassing him for the last year or so we found that deal. So again, there's deals in the market, so you just have to work harder to find them and just be a little more conservative right now.
I mean, from an ownership side, the last deal we bought here was end of 17. It was a deal in Pembroke Park, which is like west on Hallandale, which actually had a very nice pocket, but it was the same thing. It was an original owner. He owned it for 40 years. He hadn't touched the property. He kept it in good shape, but the interior still had like the green appliances from the 70s, green and brown, the shag carpet, the whole thing. So, you know, we were able to buy it at a good basis. We were able to clean it up. And I remember the day at closing, because he's owned it for so long, he comes by after he got his wire, he bought a new boat, peels out, he's out. So, you know, and good for him. And I think he paid a couple $100 grand, and we paid him a lot more. So there are deals out there, but I think, you know, to address the markets, I think Miami is unique compared to Broward and Palm Beach. Broward and Palm Beach people, I don't know, it feels like people really work here. Especially in Broward, they have normal jobs, there's infrastructure, there's industry, there's job growth, there's real companies where people go to work every day. Miami is like a real mix, so you have to be very focused on which submarket you're in and really understand the demographics of that submarket. Because we have a building in Miami Shores where I couldn't even tell you what the tenants actually do. They pay rent, but like one's a realtor, one's a stripper, one's a, you know, these are big numbers that they're paying, but I guess stripping makes money. But, you know, so.
Do you have any vacancies?
She does give out her cards if you want to go by. So I know the discounts on that. So, but, you know, so, you know, Miami is very segmented, and you really have to understand each market. Broward and Palm Beach, you can kind of cast a wider net to kind of understand the demographics on a much higher level.
I mean, being born and raised in Miami, it definitely helps. I've always wondered, you know, when I got into real estate, I was in NFL, I was willing to invest in my backyard. So growing up in different parts of Miami, I kind of know the areas where you kind of want to stay away from, and I know areas where you know, people will work hard and do the right things. And North Miami was that spot. So when Prestige first started there, it was 2016. The market was 50,000, 60,000 door, maybe 70. And today it's a whole different market. You know, I think we had a lot to do with creating a nice boom there, a renaissance. But we put work in. I have a strong supporting staff. You know, my family is strong. My wife is here as well. Our property manager. I have a really strong supporting staff, and that was the real reason why the market is drastically shifted in North Miami. Now, we haven't acquired any new buildings now because obviously, you know, we're not going to pay what people's offering us, $150 a door or $160 a door. But we entertain, but we're more of a long-term vision. And the way I see it is, I think we're in a place where, you know, in the market, it's a no man's world. I mean, no man's land, and I think the sellers and the buyers are playing this, you know, story game of who's going to budge. And I think it's a little funky spot right now. But you know, it's going to be interesting to see how it plays out.
So let's kind of focus on that, because on Greg's panel, it mentioned something about what's a big driver in the market right now is the fact that lenders are still lending, and there are private equity groups out there that are still putting money out. And you know, look, we all know the reason that everything happened in 2007, 2008, it's not because lenders wanted to stop lending. The capital markets seized up and the money dried up. I don't anticipate a situation like that, but I could see lenders pulling back a little bit. So why don't you guys talk about like some of the financing trends you're seeing? And Elvis, I want you to jump in and tell me if, even from 16 to now, if you're seeing the lenders who you were dealing with before saying, well, no, we like this deal 3 years ago, we don't like this type of deal now. So what kind of trends do you see happening now, but more importantly, what do you see in the next year or so?
I think bridge loans obviously have been a big trend over the last couple of years, and I think those are becoming more popular. But I want to spend more time on preferred equity because that's one of our expertises, and that's what we do a lot of. We've done 15,000 units of preferred equity since 2012 when we started the program. You know, the reason it's a trend is that people still believe that there's room to push rents. And operators who go in there, they want to keep their upside. They don't want to bring in an equity partner who's going to take half of their profit. They say, if I'm the one on the ground doing the work, rolling my sleeves up, I should get that money. And preferred equity has basically given those individuals that opportunity to say, listen, this is a group who's going to come in, they're going to put in equity, but they're not going to share any upside. Yeah, there's a payment for it. Usually it's anywhere from high single digits to low double digits, but there's no return after that. That's become extremely popular. Like I said, we started doing it in 2012, and a lot of groups were doing it. Now I can tell you that in the last year, I think we just did a survey in the market. There's 25 new groups in the last year who come in and are now doing preferred equity. I think that's going to continue to get...
Where are they coming from? Are they local? Are they New York?
It's really all over. I'll tell you that it's a lot of groups that previously, over the last cycle, have been owner-operators and can't place their money in new deals anymore. So they're trying to put their equity in other places, but all over geographically.
Yeah, I mean, also, we're seeing a lot on the bridge loan side, obviously. You know, that's been a big focus for us. For us, our primary bridge lending is that $5 to $20 million space. We like to be, you know, we would say that, you know, one is we're very good at execution and we're very easy to deal with because we are owners, we get the business, so we're pretty simple. You know, our rates are like that in between bank rates and what we would call hard money, so we're still in single-digit rates and we move really quickly. But what we're seeing on probably the cheaper, higher leverage bridge loans that are out there now is since everyone's able to kind of use OPM and sell away most of the paper, I mean, most bridge lenders now what they're doing is they're putting it into CLOs and selling away these tranches to different insurance companies, life cos, bigger banks, bigger funds. So they're able to really get cheap money. Unfortunately, what happens with these types of deals is you lose control once you start selling away the paper. It kind of feels like a CMBS loan. Right, it's not as bad because they still do retain the servicing and the asset management, but they lose a lot of flexibility. It was very important for us when we do our bridge lending that it's balance sheet. So you can call us and say, listen, can we do this, can we do that? I don't really have to check with 5 investors to see if this is something that we could fit our box. We can just kind of make a call on the fly. So we provide a lot more flexibility. But the fact that CLOs are selling very well and trading very well on Wall Street has definitely fueled bridge lending for the, you know, and for the foreseeable future.
I mean, from a prestige standpoint, you know, coming out of the NFL, I was able to accumulate a nice, you know, nice wealth. So I was fortunate to be in that spot and to be able to acquire properties when I was still playing. But, you know, as I continue to grow, I'm not making, you know, the double-digit annually, you know, salary anymore. So I have to position myself to where, you know, we're now open to deal with, you know, preferred equity guys. I have a gateway with the NFL, a bunch of players who see what we're doing. We have that blueprint. They see the website, they see the properties. What makes Miami so interesting that a lot of the guys, they come to Miami just for vacation. You know, they just, after off season, they have homes here and they enjoy the off season here. So we're in a spot where we can really take advantage of that gateway. And it's just all about just getting organized and now positioning myself to where we're now able to show these guys, hey, you know, it's great to have financial advisors, that's awesome, but you also can go ahead and have something that you can feel in touch. You know, a lot of the guys, I was one of them in the NFL where as soon as you get drafted at 20 years old, hey, it's your financial advisor. And, you know, I didn't have parents where we was financially savvy to be able to get educated on that. So, you know, a lot of those things where I'm trying to help some of these guys, instead of waiting until I was 28 years old to better understand it, to where we can get these guys at 21, 22 years old. And the amount of money that's being pursuit in the NFL is astronomical. It's insane. So these guys started organize that structure, and I built a very strong relationship in the NFL to where you can start at 22 years old to start doing real estate, and by the time these guys retire, they'll be making more money than they was doing in the NFL. So that's kind of where our next approach is, to where we're going to set that up to where it's prestigious to the point where we're able to run, to set up a 3,000, 5,000 type of portfolio. But now it's a matter of getting obviously the right deal in front of the table, and also having preferred equity or investors to where they believe in what we're trying to accomplish. And I think we have a very strong track record to show that. And so a matter of time where things really start taking off to where it is.
So let me ask you a question, Elvis, about the areas that you're buying. Are they opportunity zones? I know there are some opportunity zones in North Miami.
We have a few properties in opportunity zone. I mean, I have a love-hate relationship with the opportunity zone type of thing. I think whenever people start talking too much about something, it probably really don't make sense. Because whenever things do make sense, you really don't hear much about it. That's my experience. But I will say is I'm hopeful and I hope that it fulfills to where everybody think it is, because at the end of the day, a lot of these areas that's been gentrified, we need economy job boosting. Like that's imperative. That's important to what I do, because if I have all these buildings and people can't afford the rents, it hurts. So if an opportunity zone comes in and allow commercial guys to be able to save money in taxes, and now they're creating more jobs and they're reinvesting to plazas and all these different things. And there's more. Is it 50 Foot Lockers? And there's more plazas and all these things are doing well. Guess what? It's more jobs. More jobs, and people are able to pay rent. So I'm all pro opportunity, and we'll see how that plays out.
How does that factor opportunity zones into your underwriting on deals? Because it seems like it's sort of there for you, Elvis, but it's not really a big factor, and if it works, it works.
Yeah, I mean, for me, it's it's still so new, and I'm more of a guy. I like to listen and learn. So let's see how it plays out, and we got a new election coming soon, so things are sporadic with the guy who's in charge. So we'll see how that plays out.
Sure.
I mean, from our side, one is we bought a lot of debt in the past, and defaulted loans and things like that. So we have stuff in opportunity zones that you probably couldn't even give away. So if you're here, the opportunity zones are probably very good, and the bigger funds that raise big money, they're going to make big money off of it. But for us on a day-to-day, it doesn't, maybe it adds like a cherry on top, but it doesn't. We don't really factor it into economics at all.
Sure. Noah, any thoughts on that? Pass on the other thing.
I'll let these guys talk about it.
All right, so, from what I've heard then today is that I've heard we're going to be okay, right? We may have some bumps and bruises along the way, but it seems like there are lenders who are still lending money. It seems like there's plenty of preferred equity out there. There's plenty of equity. Elvis, sounds like you have an amazing pool of equity that you can tap into, that you're a trusted person there that I don't think I can walk in the door and get that equity. So you're in a really unique position, especially since most of your housing is that workforce type housing in Miami. So you're lucky in that sense. So what I'm really seeing, just from my vantage point, is that first of all, from a global perspective, the United States is still the only place you want to be. There's all sorts of turmoil everywhere else. The United States is the pretty girl at the dance step. So no matter what we say, no matter how many things we say about what's going on in our country, it is still the safest place to put money. And I think it's a testament to what's going on here in terms of the opportunity zones and our tax laws, but also really South Florida. And South Florida's market is strong. I did a deal about 6 months ago. Tal, you were on that deal with me in North Miami, and everybody told my client that he was overpaying. I always check in on the deal, and from what I understand, they've exceeded their rent numbers. They still haven't even done half of the renovations they were supposed to do. So there is still a lot of room to go. I just think it's really just tread carefully. I think I'm going to open it up to a couple of questions. I've got a couple of minutes left.
This is for Elvis. Obviously, the areas in which you're buying are probably, in North Miami, probably not the greatest areas. You got
It's a great area. You know.
Do you have a formula of what to do when you acquire properties, of kind of maybe changing out some of the tenants, or maybe just dealing with some of the problems that the past owner has dealt with?
Yeah, that's a great question and a great situation we deal with. So, I mean, what we focus on is negligence, right? That's a public enemy number one for our company, negligence. Because negligence at that point is premium because you have a lot of evictions, you have a lot of turnover. So we have to make sure everything is extremely detailed and organized from the renovation process into evictions, so that becomes very troublesome if you're not organized. And then obviously, just having the right staff, like I alluded earlier, my property manager is probably the youngest property manager in North Miami history. He's only 26, and he does a tremendous job. And it's all about having the right staff. I can't take all the credit for it. I have a tremendous staff, and I'm very thankful to have the right people around. And it's a lot of work. And the second thing I will allude on is it's all about effort and just outworking everybody. That's been our mindset, is that day and night we're going to prepare on the weekends, so make sure when we hit the floor Monday, we don't lose the time, because time is money, and you know, we have a no-nonsense tolerance as far as evictions and things like that. So it's all about educating the residents on how this operation is going to go. A lot of I didn't mention earlier, we have a lot of slumlords in North Miami when we first started. So my job is to either push them out or get them on board, and that's kind of what we're doing.
Any other questions? Sure.
So earlier it was mentioned that at this point in the game, or this point of the cycle, we're betting on the jockey, not so much on the horse. And as a small operator, where do you see more money for your dollar? Renovating outside and you know, curb appeal improvements, or within the four walls of the unit, you know, new floors, new bathrooms, type deal? What do you see that gives you the more money? And long term, how do you handle, if you take a property that is sort of distressed and neglected, how do you handle the increasing the rents and fixing the outside versus the inside?
What I would say is when you own it, right, you're going to spend the money. Either you spend it now or you can spend it as you move along. And our approach has been, we work outside in. Because when we work outside in, you got the curb appeal, you can start beginning marketing, you can start getting things on the website so we can be able to market the building. So the exterior is the most important thing. Now, once that happens, what our guys have been so great at what they do, it'll take us 4 to 6 months for that process. Now, after that, interior-wise, once a building is extremely looking the way it needs to look, you can market it, you can have a list of people waiting to rent. At that point, to do paint, kitchen, flooring is minimal. The most important thing for us is the exterior-wise. And once that happens, and you see what our product, I don't know if you've never seen it, but our product, when we renovate, we don't half-ass it. We do what we got to do because we're long-term holders. So this is for 10 to 20, 30 years type of situation. So we do windows. That's the most important thing we do. Windows and ACs, it goes hand in hand. So if your AC, especially in the summer in Miami, South Florida, if your AC is overworking, you're going to have a lot of AC issues. So when you seal the windows, that then allows the AC not to overwork. So those two things will go hand in hand. That saves you at least 20, 30% expense annually. So when we address that situation, everything else is downhill.
I also think it's important when you're talking about value add, and it's important for guys that are doing value add. I totally agree. You start with the exterior, you make it look better, you make it a warm, inviting area, and then you start with unit interiors. Because what people don't always realize, especially on performance we're seeing a lot of, is if you're going to try to upgrade the clientele and the tenant demographic, it's going to take you 2 cycles to really get through, which is a 2-year process. It's not a 12-month. You can't just all of a sudden, slap some paint and start raising rents. You really have to work with the current tenants, explain to them what the situation is, and then, you know, roll them, and then your tenant demographic is going to change, but you're still mixed with a lot of the old demographic. So it's really going to take 2 full leasing cycles until you have the demographic that you, if not longer, until you get the real demographic that you want. So changing and upgrading the interiors while you're still on your first cycle, it's not always the best thing because your demographic might not be the demographic that you want there, and they might bang up the space more, and your loss factor might be a lot higher.
The only thing I would add to that, I think that both of them are spot on, but the one thing to remember, and you kind of learn it as you go, is there's money that you spend, there's things that you spend money on that aren't going to get you any return. And there's things that you spend money on where you'll get a huge return. You replace a roof, and it costs you 50 grand. No tenant is going to give you $50 more a month because you replace the roof. That's just something you have to spend money on. It's part of our business. The other hand, you take something like pine flooring, which has been the new fad in the last 2 or 3 years. It costs you $1,000 to put pine flooring in an apartment. You can push rents $50. That's a 60% premium. The truth is you have to do both, right? You have to go after the value add that's going to bring you a big return, and you have to make sure, like Elvis said, that you're spending money on your properties. If you don't do it today, either you're going to have to do it next year, or when Elvis buys it from you, he's going to dig it off the price because you didn't do it. Just remember that as you go.
That's great advice. So one last question.
Thanks. My name is Josh Gobin. I'm a lawyer who does bankruptcy and distressed property work. And you mentioned that last time we had a credit crunch because there was no money to lend. And all we ever heard was that there was going to be a lot more money, funds would be put together, billions of dollars. I know that a lot of lenders, you guys have a lot of preferred money as well. The question is, we're just starting to hear a little bit about some stresses and some pressure, which you've alluded to. Do you feel like this time could maybe a softer, difficult period because there's so much money out there, and some of these lenders have funds set aside for these opportunities, as opposed to just a dark hole and difficult time that we had in the last cycle? Just get your opinion on if there's a softer cycle with better opportunities with all the money that's been set aside.
I was on a panel maybe 6 months ago with Denny from JLL. You guys know him. He's a brilliant guy, and he said something that I loved. It was the exact same question. I might butcher the response. Something along the lines of, there's so many groups on the sidelines right now just waiting for the downturn. As soon as something happens, those guys are going to pounce. So if you just sit around and wait for the downturn, someone's going to beat you there because they have more money than you and they're quicker than you. So to answer your question, I think it will be a softer landing.
Yeah, I mean, I agree also. I think, you know, lenders, even though they're, you know, they're aggressive now, they're definitely not as aggressive and they're a little more controlled this cycle than last. Some of the metrics still make sense, and, you know, they don't just underwrite solely to pro forma as a general basis. You are seeing deals that are over-levered, maybe with some mezz or pref equity, not Pensam pref equity because they underwrite it, right? But there are guys that have some real high-octane pref equity on these value-add deals that, you know, one is the sponsor will not make $1 if they don't hit these exorbitant pro formas, so they'll need to do some recaps or maybe lose out their position on it. So you're going to see some shakeup. You know, you're seeing it a lot actually in New York, where guys were buying with stacked up, you know, senior debt and then prefec and mezz and everything, and guys over there were buying on 3 caps, and now with all the regulation there, things are just not moving in the right direction for them. So now you have a lot of the prefec guys that are just wiping out the senior, the GP, and the equity. So, you know, it's happening, but it's slower, and, you know, the market can handle it. And as you said, there's just tons of capital sitting and waiting patiently on the sidelines.
All right, so on the last panel, the last question that was asked was, what keeps you up at night? I'm going to spin it and say, just give me a quick little blurb on what are you most excited about actually in multifamily going forward?
I think there's going to be a lot of opportunity. And the reason I say that is because I do think that people have been aggressive and they're going to start to get into some deep water. And I think for the individuals who've been patient and conservative and are ready with equity, there's going to be a slew of opportunity for them to get good assets at good pricing.
Yeah, I mean, I kind of agree. I mean, I'm looking forward to rising interest rates. I mean, I think they've kept, you know, make every deal work. If we have this shake up, you know, 100 basis point rise in interest rates, there will be a lot of opportunity out there and a little bit of blood in the streets.
Sure.
And for us, I mean, it's like when the opportunity comes, you know, we're the one who's knocking on the door. So we're going to make it happen. And like I said, when we're vertically invested, it gives us a little bit more opportunities. And so that's, you know, we get deals all the time. And but it's like I said, I think it's a funk to where it's a stare down between sellers and buyers, and whoever closes. You know, obviously, you know, something happens, you know, individually, someone has an emergency, a death, or anything happening, they need to make a move. I think that's how things are going to start to unravel, and I think it's going to be based off each person, individual situation.
Well, look, I appreciate everybody sticking around. I appreciate the panelists. You guys were phenomenal. I love it. Thank you, Franklin Street and FM Capital, for sponsoring, and go make some money today.
I want to thank you guys all for coming. Appreciate it. We'll have you back next year.